Joining me now, we've got David Stryzewski, who is the Sound Planning Group CEO. Great to have you here with us. You say that a recession is likely in the near term. So how should investors be navigating this?
Well, a couple things to just understand. The United States has about $7 trillion in debt that's maturing here in the first 6 months of 2025. So that's a big factor that we've got to be, putting into our perspective before we're making that decision. So I think that President Trump and the team right now is looking at refinancing this debt at the much lower long-term rates that we have today, but getting them lower here in the future. So his playbook is probably to allow the stock market to crash right now, which pumps the bond market because everyone goes in to buy. This then reduces the yields on that long-dated debt as $7 trillion comes due, then rolling over for a longer duration at this lower amount. So as the market shifts from a risk-on to a risk-off time frame, I think it's important to understand that a move like this would then potentially cause the Fed to drop rates, which then gets the economy really moving in some different ways. But with that being said, there's a lot of uncertainty today given the liquidity of the tariffs and kind of the back and forth on things. So where do people go? It is an important question. I think ultimately you have to have your anchors in place. And my concern is that the bond market isn't going to be able to, as a whole, keep people in the same way that it has in the past.
You say it so simply, as if just allowing it to crash means that we could instantly have some type of recovery. That recovery could be one that takes months, years even. And as we think back to previous crashes that we've seen, that means a lot of longstanding implications for how people are able to get back into jobs, how their wages in those jobs are able to outlast any forms of economic shocks that they're incurring. So all of these things considered, you've got pretty much every generation that will feel a different impact at a different part of their own purchasing cycle or family formation. So all of those things considered, how do you then plan for a portfolio that outlasts any of those major shocks?
Well, if you're nearing or entering retirement, this is the question. Because sequence of return risk is extremely high right now. What's that? It's within the last 5 to 10 years of your working career, the first 5 to 10 years of retirement. If you have a major downturn, a setback like that, or call it a financial injury like that, it could literally change the course of your retirement. So what you have to do is you have to have your anchors in place. And so here's an idea that is a little bit unconventional potentially, but hear me out because the math and science bears true. So there's 5 different ways that bonds can both make and lose money. And right now, those are kind of all on the table. I'm concerned that we go into a higher interest or higher inflationary environment in the future. We call it tarifflation, if you will, because there's certainly parts of our economy that the Fed cannot affect, like our eggs prices that you just noted, 59% increase over the last 12 months. That's a big deal. But the point is that as we're moving forward right now in this tariff conversation, what do? I think that people should be looking at bond alternatives. Personal one that I like right now is a growth-oriented fixed index annuity. This is a hedging strategy that gives you the ability to have none of the downside of a market, but reasonable rates of return on the upside. It links to an index like the S&P 500. And so this gives us an easy way on an annualized basis to have a reset, because if the market falls apart, guess what? Zero's my hero. I can allocate back in. I've got dry powder. This gives a baby boomer or somebody nearing or entering retirement the ability to dollar cost average while also potentially staying ahead of inflation because of that the index linking component to it. And so these have been working out exceptional, but ultimately, I think there's never been a better time to actually own one than the present moment that we're in right now.
You're also looking across some of the precious metals or miners. Why is that?
Okay, so precious metals so there's 2 different ways to play metals here. We got precious and we got miners. I think the precious metals, just watch the numbers right now. Looks like gold is going to be achieving the 3,000 marker here, within the next week or so. But watch silver as it is literally at about a 35% discount to its all-time high of $50. And I think that it's moving. The Trump administration has actually brought back 2,000 tons of gold to the United States here since December. That's something that's out there. You just have to do the research to understand it. But just know this as well. We're also doing an audit on Fort Knox here in the month of March. And so if there's an audit on Fort Knox, it's either going to be good for the United States that it's all there, or maybe not as good. I'm not really sure. But the point is that there's a revaluation that's going on. Bankers don't do anything unless it's in their best interest. And right now they're allocating and bringing back some gold. So I think this is an important way to play it. One of the ways to do that is with the miners. And so miners have been beaten up for decades. And ultimately, I think they're going to be the sector that will lead our economy in the next 3, 5, and even 10 years as we're doing more drilling, and we need more strategic minerals because as the price of these things go up, the need for some of this stuff continues to move forward. That is going to become key worldwide for electrifying, AI, data centers. It all needs materials, and so we've got to get them somehow.
All right, David, thanks for taking the time here with us today.
Pleasure.